Hi everyone, welcome back to the Smash Property Podcast. This week's episode is the February property market update. We've got a lot to cover in this one. We're going to talk through the recent RBA interest rate hike. I'm going to talk through my opinions on where I see interest rates going and how the market will be impacted, and also what investors should be preparing for 2026. We're going to look at the national property market, what is happening across each of the capital cities, and go through at the end some areas that I think you can focus on for budgets under 600,000 and budgets over 600,000, plus a few things more throughout the episode. If you're new, welcome. My name is Nick V. I'm the founder and director of the Smash Property Investing Buyers Agency, and every month we bring to you a property market update with an unbiased opinion. So if you are out there looking to DIY, you can use some of this information and form your own opinion. Now, I do encourage you, validate what I'm saying. Don't just go off and make decisions on what you see in this episode. This is definitely not financial advice. I will say also, I see, just like you, there are so many property commentators out there these days. And it shits me. I just literally before filming this saw a buyer's agent advertising the fact that they are buying and promoting Broken Hill, New South Wales. Now, no disrespect to Broken Hill and the residents of Broken Hill, but it is not an area that you want to be investing your hard-earned money. There's so much shit out there today, so just be extremely careful. Don't just go and base your decisions off what you see in my content or anyone else's. Go and validate it. Speak to a few people, because the last thing you want to do is buy somewhere like a Broken Hill and be stuck. So that out of the way, if you get some value out of the episode, appreciate a thumbs up. Consider subscribing if you haven't already. Shout out to all of our weekly supporters, actually, I should say, because we have a podcast every single week out on YouTube and Spotify. But let's have a look at what is happening across the Australian property market. Now, in January, the Australian property market moved by 0.8%, which is roughly a $6,000 increase in price. Now, I always love to put the percentages in price increase so that we can actually have some like relativity to it. Like, we know, what does 0.8% mean, right? It's $6,000 the price has moved. Now, 2026 is an interesting proposition. Now, if you watch these market updates regularly, you kind of know my sentiment about 2026. And it is not a rising tide market, meaning that, all areas like we've seen are going to go up massively in value. It is scary. Honestly, for me as a buyer's agent, it's a scary time to be making property investment decisions. So if I'm saying that as a buyer's agent, I can bet as maybe a first-time investor, if you're looking to get into the market for the first time, it may feel extremely confusing because there's so many conflicting opinions out there. But for me, opinions aside, the fundamentals of the market are just vastly different right now. And I'll touch on some of those things in a minute. But at a high level, Perth, Brisbane are leading from a data point of view. Sydney, Melbourne are sort of lagging from a data point of view. And I'm going to touch on the on-the-ground differences with those particular capital cities in just a second. But it's a great example of data-driven investing isn't always going to be the smart move. And I'll show you an example of that as we move forward. Now, regional markets are performing reasonably well. In fact, very well in a lot of cases, simply by the pure fact of them being affordable and there being reasonably good rental pressure. All right. So you've got a lot of markets in the sub 600K range where a lot of investors are going, rightfully so. It makes a lot of sense. I've done it personally myself. And in those markets, the stock is very, very tight. So we've got very, very high rents, which is equating to a decent yield for a lot of investors out there. But not all regional markets are doing that. And as an example, regional Queensland, which we were buying for a very long time, over the last few years has gotten to the peak of its, or very close to in some markets, the peak of its cycle. Not that it's really slowing down, but I'm not buying there. I'm not rushing to buy there for most clients. There are anomalies. When I say anomalies, for the certain investors with that need a certain type of property in their portfolio, but it's very rarely at the moment first-time investors going into those markets. And again, data-driven investing, if you're looking at data from regional Queensland, it looks amazing. Why? Because all the growth has already happened. We don't want to do that. We want to buy where the growth hasn't occurred just yet. And I'll show you some areas in just a second on where that could be. Let's talk about interest rates. Okay. At the time of filming this, the RBA has risen the cash rate by 0.25%, as you would already know. And I'm seeing a lot of investors already get spooked by that. A lot of investors want to pause buying a property. A lot of investors, there's some that wanted to pull out of deals. There's some that just wanted to stop their property investing journey altogether, and some that even are thinking about selling down. Now, here's my opinion. Just because the cost of money has increased by 0.25%, you're telling me you want to put your goals on hold for that? There's a long way to go for a lot of people to get to their property investing goals and the outcome they are looking for, which is for most people want the freedom. They want the choice to do whatever the hell they want to do. And if we're going to let a 0.25% increase in cost steer us away from that path, you got to look yourself in the mirror and ask, are you dedicated to this journey or not? Because interest rates are a cost of doing business in property investing. They are going to go up. They are going to go down. We have no control over that other than the fact of the decisions that we make and the choices we make. And I'll give you an example of my journey, right? You may remember on the back end of COVID, rates were like 0.1% at the cash rate, lowest they've ever been historically, right? And then we saw the sharpest increase in interest rate history shortly after that time period. Now, I was extremely leveraged at that point in time. Interest rates were going up month after month after decision from the RBA. I didn't sell down. I didn't panic. I just changed the direction that I was moving. So instead of just going and buying freestanding houses in high growth locations, I pivoted to high yielding assets. Okay, so that the cash flow of the portfolio was slightly managed a little bit easier than if I was just going down that same path and that same strategy I was originally. So the point being is that we just have to change the way that we are moving forward. But if we stop moving forward, you can, I want to say kiss goodbye to your goals. That's a bit dramatic, but you are just going to push that goal that you're trying to achieve further down the line. So a couple of reasons not to panic. Interest rates, when they increase, all they really do is slow activity down. They don't reverse prices. In a lot of cases, they don't really stop growth. If we think about it, interest rates gone up. That means there's a few people less that have less borrowing capacity. Few people might be priced out of the market, and therefore we can have potentially less competition. Less competition produces great buying opportunities for those that are already in the market or wanting to get in. So higher rates first impact borrowing power and sometimes transaction volumes, but very rarely do they ever impact asset values. Don't believe me? Go and have a look historically at when interest rates have gone up in this country, what has directly happened to property prices. And I guarantee you they have not gone back down. Now, they will remove weak buyers before they hurt strong assets. Like I was just saying, a lot of people that will get fearful are going to sort of pull out of moving forward and buying property, but they're not going to hurt strong assets in strong locations by any stretch of the imagination, especially not at 0.25% increase. Come on. Now, the opportunity that it creates is an amazing buying opportunity for the people that are not hesitating, for the people that have enough confidence in themselves to make the right decision and have enough financial buffer to cater for any further interest rate increases that we may see through the year. Now, how should investors approach this scenario? Now, if you see me looking down, I've got our property market update, which is live on our website. If you want to see the PDF version, head to smashproperty.com.au, click on resources, and one of the first PDFs on the page will be the property market update that I'm going through right here. So you can see for yourself all the stuff in detail. Now, how to approach this if you're saying, no, I get it, Nick. I still want to get into the market. I still want to move forward. How do I do it? How did you do it? So the way that I approach it is I stress test my numbers, right? Numbers, and as we always say at Smash Property, numbers, let the numbers do the talking, okay? So if you are assessing a deal, right, you haven't yet made the decision and got in yet, when you're working out your cash flow, so you might have a spreadsheet. If you're one of our clients, you'll have one of our spreadsheets where you just input a higher rate, right? So a lot of people around the 6-ish%, some high, some a bit lower. Go, okay, if it's 1% higher than what you're currently paying, what does it look like in terms of the cash flow at the end of the day? Now, if you don't know what cash flow is, it's simply the rental income minus the expenses. What are you left with? In most circumstances, it's generally going to be some kind of negative position. But are you okay with that, right? Are you comfortable holding that? And I will just preface here, no one's ever going to be really comfortable with losing money. Let's just be real. But the reality of it is that we are buying property with the idea of building wealth. Now, if the property is growing in value far greater than the cash flow input on an annual basis, you are ahead. So for example, if a property is growing by, let's say conservatively 50 grand a year, okay, and it's only costing you 15 grand a year, okay, you're ahead, right? Your 15 grand cash has been input into it. That's before tax too, by the way, but your property's grown by 50 grand. So that difference is what your net position has increased. Now, we buy properties that will far outstrip that 50K growth on an annual basis, but that's just a light example. All right, so stress test your numbers, put a 1, maybe 2%, maybe 3%, depends on your risk appetite and where you think things might be going, but just test things out. Look at what sort of cash buffers that you have if there's a vacancy for a period of time, right? Let's say the tenant wants to move out, you got to advertise for a new tenant. What that difference for a week, 2, 3, 4 weeks, whatever you think is realistic for you and the area that you've bought, can you manage that if that were to happen? Okay, that's what I would be doing. I would be focusing on assets that are still desirable if interest rates were to continue going up, right? So just back to the example earlier, I bought some high cash flow assets, 22, 23, I think, somewhere like that. It was spitting out, 10 grand a year after all expenses. So mortgage, all of the expenses, property manager rates, etc. It was spitting out about 10 grand positive, even at, I think the rate we've got there, because this is might be with the first Mac, I think it is, 6.8 something, right? And it's spitting out 10 grand on top after that. So those are the kind of assets where I'm like, okay, cool. I've got my growth assets, right, in capital cities. I needed some cash flow to balance out that negative position. That's where that asset makes sense. For your first investment, I wouldn't be going there because the property hasn't grown in value. All right. So for a first investment, that would be shit. So this is why I always say, people always ask like, oh, what areas are you buying? And it's like, I'm buying the area where it makes sense for the investor, right? That area won't make sense for a first-time investor. That would be horrible because you're not going to get any growth. For someone who might have 5, 6 properties, maybe it makes sense. All right. What to expect for the rest of the year when it comes to interest rates? Look, I don't like to speculate and pretend like I know where interest rates are going. No one knows. All right. My best guess, I look at things like the cash rate futures, and it's by no means an accurate measure of where interest rates are going. But I like to just go, hey, what are the markets sort of predicting here? And there looks like there might be further rate rises on the cards, but no one knows, right? Anything can happen. But I would expect and not be surprised if interest rates went up maybe another 25 basis points, maybe even higher than that. I don't expect any cuts this year. I obviously, like you, would welcome them. It's just the dream of like interest. Man, I was saying to Akira that day, imagine interest rates went back to like 3%, 4%. Man, you know how good everyone would be. Anyway, we can dream. Back to reality. They're not going there anytime soon. Anyway, borrowing power is not really going to improve in the short term unless your income improves with it. All right. So I hate to be the bearer of ordinary news, but that is just the way that I see it. Is that going to happen in reality? Well, stay tuned. Month on month, Smash Property Market Update will keep you informed as to what is going on. Now, my favorite part of the show is the capital city performance, and we'll get it up on the screen so you can see what is happening. I like to rank these in order. Again, if you want to see this PDF version, it's on the website, smashproperty.com.au. Click on resources and you can download this for free. No emails required or anything. Now, the capital city leading the charge here is Perth. It's there every month. Perth is just there. It grew 2% in the month of January, which equates to about $19,000 increase in value at the median level in the month, which is insanity. Annualized, it's up 18.5%. Median value sitting just shy of $1 million in Perth. Can you believe it? Brisbane sitting second. It grew in the month of January 1.6%, which is about $17,000 increase in value in the month. Annually up 15.7%. Median values ticked a little over $1 million there in Brisbane. Darwin up 1.5% in the month of January, which is just shy of 10K increase in the month. Annually, it's leading the charge out of all the capital cities on an annual basis. It's up 19.7%. Median value has just ticked over $600,000. I will read this all out, and then I'm going to give you my views on each, or maybe not each of them, but most of these capital cities in just a sec. Adelaide up 1.2% in the month, which is about $11,000 increase in value in January. Annually up 12.4%, which is huge. Median value there just a little over $900,000. Hobart up 0.5%. Canberra up 0.3%. Sydney up 0.2%. Melbourne up 0.1%. So Hobart, Canberra, Sydney, Melbourne, from a data point of view, not really doing that well from the data, all right? Perth, Brisbane, Darwin, Adelaide, all looking extremely strong. Now, why did I say that data-driven investing is not always the smartest way to go about things? Because we are seeing Perth, Brisbane do extremely well from a data point of view. Now, the challenge with Perth at the moment, it has very good conditions for property price increase. And you might be like, oh, that's great. I want to go there. The challenge I'm seeing with Perth, and I love Perth, right? I do try to buy there where possible. But the challenges that I'm seeing is because it does still have an extremely constricted supply and a reasonably large population growth that is continuing month on month. People are obviously continuing to move there and migrate there for various reasons, largely jobs. The assets that these people in Perth are buying are largely owner-occupiers looking to get into, they just want to get into the market. And they are overpaying. When I say overpaying where the numbers don't really stack up anymore from an investment point of view, right? Like you can still get into the market there, right? And you're still going to ride a bit of a growth wave. But because of the prices, the rents haven't quite caught up yet. So the yields are deteriorating and have been for a long time in Perth. Don't love that. Don't love that we can't really negotiate on price. We're often having to pay, well, not us, but people buying there, well over asking just to get in that market. Now, that's not to say there aren't good deals in Perth. We are still transacting good deals, but they are largely off market, or they are largely not owner-occupied appeal properties. So that's why, again, data here, it's like, okay, you could get into Perth. You're probably going to have to overpay. You're going to have to compete with, multiple other buyers. Are you getting a good deal? I don't really know. In my opinion, no. Brisbane, similar. Brisbane is similar, but Brisbane is a different market altogether because it's not just Perth isolated. Maybe you've got Bunbury to the south, but Brisbane, you've got Sunshine Coast to the north, Goldie to the south. There's a bit of the market has a bit more absorption in it. So there are opportunities to buy reasonably good properties in and around the Brisbane area. Again, the properties that make sense are the ones where the owner occupiers are not interested in, right? So this means you're going to be looking at something that might need a bit of TLC, which is a great way to negotiate on price. Ideally, get yourself a discount. You uplift the property, properties rising in value as Brisbane's going crazy, and the value uplift should supercharge the growth of the property if you do it right. You can absolutely get it wrong. It doesn't mean all renos are good. That's not the case. But that's where Brisbane's maybe a little bit different. You can maybe squeeze a bit of a better deal out there. Darwin, I'm not touching Darwin with a 10-foot pole. I know there's some buyers agents there jumping into Darwin. Not for me. I don't like the long-term hold of Darwin. I know there's some BAs out there they'll get into a market, they get all the investors into the market, and then they want to like sell, and they tell all the investors to sell, and then they go to another area like Locusts, right? That might suit some investors we work with, but for majority of people, they're not the buy, hold, flip it, move, this, that. The exit and entry cost of doing that eat away at the profits significantly. So Darwin is not really for me. I know there's some high yields in Darwin. Cool. Maybe if you've already got, a decent growth-based portfolio already, Darwin might make a little bit of sense for you. But for the first timers, don't really. I wouldn't touch it at the moment. Adelaide, Adelaide. I'm not buying in Adelaide predominantly. I'm not buying in South Australia at the moment. Really, there'd be some good deals there, no doubt. I would be very selective. I'd be wanting to buy well below the median of 900 in Adelaide, which pretty much eliminates you to not much but the northern part of Adelaide, Elizabeth, Salisbury area, Playford region, I should say. Hobart, not buying there. I'm not saying it's shit, but selective, I would say, if you are going to look at Hobart, and have a good reason, like, transport, university, like schools, like education, health, kind of want to be in and around those sort of hubs. Canberra, I like Canberra. I'm going to say that. I like Canberra for the pure fact of very high income, like reasonably high income in Canberra. There is a bit of funniness with some of the I guess the property laws down there. So you want to get that checked. You want to know what they are and your obligations and that sort of thing prior. Some good opportunities, I think, in Canberra, and particularly when you've got a median value at $885,000 comparable to the other capital cities. It's stacking up to be quite, decent growth over the next, I would say maybe sort of 2 to 5 years, something like that. And if you've not been to Canberra, I was about a year, 12 months ago, I was in Canberra. I like it. I like it a lot. It's got a lot to offer. So if you haven't been, if you live in Sydney, you live in Melbourne, head down, do a weekend trip in Canberra. You won't regret it. It's nice. Sydney, I wouldn't buy in Sydney in these brand new areas. I say it all the time, these greenfield developments, which there are heaps of them in Sydney. Don't buy these properties. In Sydney, it's the unit market. Like I said, previous month, that sentiment has not changed. And the established owner-occupied areas. But to be honest, for an investment property, Sydney doesn't really make a lot of sense, guys. So I wouldn't really be encouraging that for the most part, because you're going to soak up pretty much most of, if not all, your borrowing capacity. If you're not buying the right property at the right price, it doesn't really make sense. So I wouldn't really be recommending Sydney. Melbourne is last on this list, but I'm buying in Melbourne a lot. I love Melbourne. I love the western part of Melbourne. I love the eastern side of Melbourne. It's got a lot to offer. It's got a lot of great deals. The vendors there are very realistic. Vendors there are discounting their properties at the moment. I'm working on a deal, probably by the time this episode is released, a $40,000 discount on the asking price. That's a great thing. Regardless of where you're buying, that's a great thing. So I love Melbourne. I love the unit market there. I love the established unit market there. Don't do the high-rise shit. I love the established house market there. Don't do the new build stuff. So that's the capital cities over January. I feel like I've rambled a lot. But what's driving the market, you ask? Well, before I get into telling you what's driving it, if you got some value out of all of that, Appreciate a thumbs up, man. Help us out here. We need more people to know about this because, again, if you come and decide to work with us, amazing. That's cool. But for the vast majority of people that watch this, I want you to be able to walk away from this being like, yeah, I learned something new. That was valuable. There was no bullshit spin about I've got to use this guy's buyer's agent and all the locations are, top secret and the strategy's an illusion and all this sort of things. No, we're real. We're real investors that have skin in the game all across the country, right? I've got properties in Victoria, New South Wales, Queensland, WA, all in my own portfolio. So, yeah, help us out. Thumbs up. Thank you. My dog just moved the camera. Oh, yeah. All right. It's back. What's driving the market? Well, population and migration are large supporters for the underlying demand in a lot of these areas. Rental vacancies are extremely tight and near basic historical lows in so many different areas, right? Everywhere from still regional Queensland through the southeast Queensland region, Sydney, Melbourne, WA, vacancy rates are extremely low. Where I like to buy the lower price stock is outperforming largely due to the serviceability pressure that a lot of investors are seeing, right? Units are regaining a lot of relevance, largely, again, because of affordability that is tightening across the country as well. Supply is extremely constricted. Listings are still well below their long-term averages. Construction pipeline is still pretty weak. And high build costs are still around, right? And it's sort of suppressing new supply to a certain degree. Now, some opportunities that I see, okay? Now, I did say Perth is obviously leading from a data point of view and be selective around that. So what I will be looking at is buying assets with quality land content if you can, or buying an asset with still a strong yield that is intact after purchase. Now, if buyer competition is there, I wouldn't say don't pursue the opportunity further, but just be wary and be ready to pull out if there's a lot of competition. So that might mean you might need to buy the ugly duckling, which I always say is a great thing if you can do that. But make sure the yield is intact after your purchase of the property. So I'm not saying don't buy Perth, just be more selective than I've ever recommended in the past. Now, Brisbane. Brisbane's Mr. Consistency, as I've called Brisbane quite a few times. Ongoing population inflow into Brisbane. It's extremely undersupplied across a lot of the city. It's got a pretty good balanced growth and income profile, which is important, right? If growth gets too far away from incomes, that's when it gets a bit unstable. But Brisbane is still there. So on the ground, you're likely going to have a multi-offer scenario pretty much for most properties that you look at, even the sort of ugly ducklings that you might be wanting to scout out as well. That doesn't mean it's a bad thing. It just means your first and final offer is often how things work. You got to make decisions quickly. You can't sit on stuff for too long, particularly, in fact, pretty much anywhere in the country right now. If you're going to sit on it for a few days, even longer, you can kiss goodbye to the opportunity. As always with Brisbane, the flood/insurance risk needs to be considered, and make sure you get that checked and don't just rely on the agent telling you so. Some more opportunities in Melbourne. Melbourne is still mispriced in a lot of the areas. I cannot believe that we are buying properties, houses, freestanding, good quality, low set brick houses, sometimes well under 700,000, which just blows my mind, because where are you getting that? Brisbane, that was maybe a year, maybe 18 months ago, you were maybe able to do that. Not anymore. Definitely not Brisbane, certainly not Sydney, and definitely not Perth for the most part either. So Melbourne, amazing value. If you're not looking at Melbourne, give it a go. I know the land tax puts a lot of people off. I know the stamp duty puts a lot of people off, but look at the bigger picture, guys. Those are short-term costs. We want to look at the long-term gain. Melbourne is a long-term market. It's not going to be, a quick get in, get out type of Darwin, for example. Melbourne is a long-term play. So it's underperformed for a very, very long time. despite the headline numbers that I just showed you, I'm seeing growth even on townhouses, 30, 40, 50K in the first sort of 3 to 6 months, which is insane, right? When you look at the data says Melbourne's shit. But when you look at what's actually happening and the way that we're buying, there's some amazing opportunities there in Melbourne. Vendors are very realistic, right? So people are open to negotiation. They're open to selling a property less than what they were originally asking for, which is amazing for buyers, right? That's how you get good deals. You don't get good deals by just getting into a hot market and praying and hoping for the best. Some risks, like I said, Perth. If you're not buying the right asset at the right price in the right conditions in Perth, you're overpaying and you're going to get yourself potentially stuck. So like I said, look at the fundamentals of the deal and why you need the deal. What job do you need the property to do, right? Is it yield? Because you might have a few properties already. Is it that you need growth? What are you sort of looking for? If the deal doesn't stack up for one of those two things, ain't good. Regional Queensland, bit of risk here in that the buyer depth is thinning out. You've got vendors that their price expectations are a little detached from the demand in regional Queensland, right? They've seen all this hectic growth over the last sort of 2, 3, 4, 5 years, and they're trying to capitalize on that. It's not really starting to come through. Properties are sitting on market a little bit longer. You've got a lot of BAs that are pulled out there, so it's really just the DIY investors that are buying there for the most part. And the liquidity risk on the exit, now that the days on market are starting to increase, is something to consider. Now, again, doesn't mean to say don't buy there. It's just be very selective and know the reason you want to buy there. Don't just go, because the numbers, the data said it was good. The numbers of the deal need to stack up, not the numbers on the screen from whatever data aggregator you're using. Some other risks, the fringe estates in Sydney and Melbourne, those greenfield estates, there's an oversupply risk. There's no scarcity value, and rental demand is a little bit softer there than other parts of those capital cities. Now, onto where to focus for budgets under $600,000. Now, it hasn't really changed from January. Property doesn't really move that quick anyway. So this may not be too much of a surprise, but under $600,000 for freestanding houses, I would be looking at regional Victoria, regional New South Wales. Now, in regional Victoria, your Bendigo, Ballarat areas, parts of Geelong, parts of Shepparton, Warrnambool, those type of areas. Go with a larger regional centre if you can. If your budget's sort of a bit lower than that, you want a freestanding house, you're going to have to go into a smaller regional location. Your Benellas, your Wangarats, your Kyabrams, Yarrawongas, those type of things there. If you're after a freestanding house in Victoria. Now, regional New South Wales, again, go with your major hubs, your Alburys, your Waggas, your Tamworths, those types of locations. One that's not on this PDF is under 600,000. Don't sleep on capital city townhouses and potentially units as well. Now, if you see regional locations as too much of a risk, you're like, hey, not too confident in the growth of this area sustainably over the long term, then townhouses in capital cities offer an amazing opportunity. And we've got a few properties actually that fit that category that have done amazingly well over sort of five-ish years. So don't just get fixated on freestanding houses if your budget's not stretching that far. Now, where to focus over $600,000. Now, there's a few here. Brisbane, the middle ring of Brisbane. You're probably in the freestanding house market really looking at sort of 800 plus for a decent quality home in Brisbane. Again, you can probably get some townhouses in Brisbane. I probably wouldn't go that far with a Brisbane townhouse at the moment. The Melbourne middle ring as well. So I love Dandenong, Frankston. I even love parts of Werribee, not all, but parts of Werribee, and even some of the northern part of Melbourne as well. Extremely good buying for a lot of investors. Now, regional Victoria, for a freestanding house, Geelong, Bendigo, Ballarat. Now, these are the A grade hubs. You got to be, I wouldn't be rushing to buy property in those markets for over 600,000. Like, I would want to get it under that price. But if you're kind of like, hey, budget doesn't really stretch far enough to get a decent quality freestanding house in Melbourne, that's when those regional locations might make sense for you. But you just got to look at like where you are on your journey, right? Are you at the beginning? Do you need some high growth assets? Are you maybe at the middle where you might need to balance some cash flow? Or are you maybe sort of towards the end where you've maybe got to look at a few different options to maximize the gain that you're going to get? So take it with a grain of salt, the A grade hubs in Victoria. Or if you're like, nah, don't want any of those things, some Sydney units, some of the boutique Sydney units, low density blocks, established suburbs, get them under $1 million, under 900,000. But I can see that being decent-ish value. I'm not doing any of that personally right now, but again, maybe you're just kind of like, hey, screw the whole thing. I want to buy in Sydney and I want a unit. That's what I would recommend. So look, my take on this is 2026 is an interesting year for property investors. Outcomes are going to diverge sharply between, investments that return and investments that flounder and don't get you anywhere closer to your goals. So you've got to be very careful about where you buy. This is not just downloading a suburb hot list, not just downloading what I've got here, right? Do your own validation of things. Ideally, you want feet on the ground so you can see what is going on for yourself. It is underrated. Or if you need the help, that's when a buyer's agent can really add extreme amount of value to that if you're too busy with the things that you're doing. So be cautious this year. Don't just buy anything and hope that is going to grow in value. This is definitely not the year for that anymore. Now, if you need help on your property investing journey, this is what my team and I specialize in helping people on their specific part of the journey, right? We don't have generic strategies. We don't have generic suburb areas that we're buying. We tailor both of those things, the strategy and the area, to you as the investor, because not all areas are the same. A property needs to have a job to do for you, right? And that job will be different for me as it is for you, as it is for anyone else. So it's important that whoever you work with, whether it's me and the team or anyone else, that they are specifically tailoring the plan, the strategy to you. If you want help and you're on YouTube or Spotify, there is a link in the description where you can book a clarity call where we'll just explain, like, this is what we do, this is how we do it. Is it going to be right for you? And move forward. Worst case, you get clear on what your next move looks like. Best case, we turn you into a property investor. That's all we have time for this week. Thank you so much for watching. If you got this far, appreciate a thumbs up. And again, consider subscribing if you haven't already. I think like 80% of you are not subscribed. Would help us out tremendously if we get that done. Until next time, thanks so much. I'm Nick V. Thanks for watching. Catch you soon.